My name is Chris. This is Wheelhouse Trading and welcome to the Wheelhouse. Okay, I got a special video for you. It's going to be a tutorial style video. I'm going to teach you a way to get out of your positions quickly without having to risk too much time in the trade. Mitigate your losses, lower your risk, de-risk out of it, and what I'm going to teach you is how the institutions, the funds, and the whales do it, which creates a bull trap. And what is a bull trap? A bull trap is typically something like this. Okay, this is Bitcoin, and right over in here you get your buy signals, and it breaks out of a resistance. And right there, where some of the conditions are met, and people come in and they buy Bitcoin. Okay, and it goes up and up and up and up, and you think you're in a rally. Your ribbon is blue. You end up going above the 200. You know, everything looks good. More people buy in. More people buy in. More people buy in, and rejection and then a quick fail. And if you bought in, here, or here, you got trapped. And if you didn't use the stop loss, you got caught holding the bag and you're down, a certain amount of money already. Okay. Now, the bull trap is bad if you're the one that buys with the conditions and you end up holding the bag. That's not good. I'm going to teach you how to get out of those positions. You will need money to get out, but I will teach you the order to do it in. I will teach you exactly how to do it, show you that you don't have to be in very long. I'm talking about minutes, okay, to de-risk. And, if you had a lot of money, this is how you would create a bull trap. But, I'm assuming most people don't have like the institutional type money that are on this channel, but still I want to show you. So essentially a bull trap is you'll get conditions, buy signals, you'll buy in, maybe there's FOMO, conditions, whatever, it breaks out and then it fails on you. And it happens a lot. And you go, well, why did this happen? It looks so good. Technically, it looks so good. Everybody was in the news. Everybody was talking about it on YouTube and it fails. Well, the reason it does that is because somebody that owns Bitcoin that bought over here, that's been down in it for a while, says, you know what, I'm going to go ahead and I'm going to put a lot of money in and I'm going to try to get out of my Bitcoin trade. And let's just for simple numbers here, I slide this over. Okay. So let's just say that right here, let's say they bought right here and they're down 18%. Okay. So they bought here and it's done nothing but go down, and they decide right over here, well, I'm going to get out of my position. So in order to go down 18%, whatever it is that you have invested, you need to double it to get to 9%. You need to triple it to get to 4.5%. Okay, you need to quadruple it to get to 2.25% loss. You need to go 5x your original investment to get to 1.25%. And you need to 6x to get to 0.625% down. So if you have 6 times the amount of money and you can spot momentum conditionally on, say, the minutes or the hour, however you want to do it, and you say, okay, as soon as this thing turns blue and it starts going up into momentum, I'm going to go ahead and put 6 times the amount of money into Bitcoin that I originally did. And now my 18% loss is going to go to 0.62% loss. And that momentum is going to bring me back up to even. And I'm just going to get out. And I want to get out because I think that Bitcoin is going to be coming down overall. So they're putting in a bunch of money buying. And that shows up in the technicals. It shows momentum. It shows volume. And it can create a bull trap when they start selling. Now, when a lot of people do this, or really big whales do this, this is how it is created. This red line and this red ribbon and this red cloud and being under the 200 says Bitcoin is going to continue to go down. Okay. However, if you don't want to wait for it to figure out where it bottoms and starts to go back up, then what you have to do is you have to use muscle. You have to use more money and you have to figure out the calculation that's going to reduce your loss into a small percentage into momentum. So it brings you up to even or even a little profit and then get out. Now, the first thing that you do this with in your portfolio is what you're down the least on. So let's say you have something that you're down 10% on, you have something that you're down 20% on, something you're down 30% on, something you're down 50% on, and something you're down 80% on. You don't even look at anything in there. You don't look at anything in your portfolio down except that one that is 10%. It's going to cost you the least amount of money to get out of that. And it is also the least amount of risk with your money to get out of that. And you always want to start with the lowest loss percentage first. So if you're down 10% and you double it, you're only down 5%. If you triple it, okay, you're down 2.5%. Okay, if you're quadruple it, you're down 1.25%. And if you go 5x, you're down 0.625%, right? So let's say you have something down 10%, you go 5 times into momentum, and you just get out. You just literally, you're down 0.062. It's not that big of a deal to lose 0.062 when you have a declining market or potential market crash going on, right? That means that if you were down, let's say you had 150 grand and you were down 30%. So 50 grand of it is gone in paper losses and you only have 100 grand left. You need to start working on a plan. And the plan starts with getting rid of your losers and mitigating your risk. But you got to go one at a time if you don't have a ton of money. And you also want to, you don't even have to have the momentum. You just have to have the money, honestly. It could still be going down on the minutes. You just need to muscle down on it and take that 30% loss. 1 time is 15, 2 times is 7.5, 3 times is 3.75, 4 times is whatever it is. And you just X amount of times in till your loss is very small and then exit. Now you've mitigated your losses. If you got every one of them down to 10% loss instead of 30, 40, 50, 60, 70, 80, well, that 10% loss is 90 cents on the dollar. So however big your account is, you can de-risk, and taking 90 cents on the dollar isn't the worst thing if you're trying to get out. Let's say you're in margin, you think the market's going to continue to go down, whatever it may be. That is not a bad idea, okay? I've been doing it. I've been doing it constantly. I did it last Friday on about 6 positions, and here's the kicker. The lowest percentage you start with first, okay? Boom. You put all the money in, you'll see it. Your average cost will go way down, your percentage, and you just sell it. And now you have more money because you had the money that you put in to muscle down plus whatever your original position. Then the next one, you put it all in. If it's down 12%, 1 time is 6%, 2 times is 3%, 3 times is 1.5%, 4 times is 0.75%, 5 times is 0.375%. Well, you're only down 1/3 of 1% by putting 5x in. So put it in, boom, and then pull it right out. That's how these bull traps are created. That's how this fast, violent momentum is traded. When we were in December and we saw it revolving from all the different sectors and this stock, what that was, that bubbling volume was big funds, prop trading firms, institutions saying, I need to get on my position. And they would throw a ton of money on a position, build momentum, get people to buy in to help push them up. And then they would get to even or a little profit or reduce their risk and then de-risk the whole thing. And they just work down the line in their portfolio. And the further you get down the line in your portfolio, the more money you have and the less loss you have. So that is a really, really good way to reduce your risk, get out of a damaging market, stop the bleeding, stop the losses, and then mitigate the amount that you lose just by buying a ton more shares mathematically to lower your cost, which brings down your average. And then it's just put it all in, lower that cost, and pull it all out. And you can do it within like 5 minutes. Literally execute. Very fast. Boom, 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 until you get it all to the side. It's best to do it into momentum when there's conditions and buy signals on the hourly or the 1 minute, something like that, where it's going up so you don't have to put in as much. Like maybe you only want to get it down to 2% and you're in a nice momentum. Well, that 2% might go all the way up and shave another 1% without you having to put the risk of the money in. You can do that. But if you have a lot of money, you can just, if you have 1,000 shares and you can afford 20,000 more shares, you're going to be able to reduce that average cost if it's way down. And you're going to be able to execute it and then resell it and just put it back in your account. And that is how these momentums and these bull traps start. And you'll see a lot of them when the markets are down and these big guys need to get out of their positions, okay? What a lot of people do is they buy a position and it goes down 7% and then it's down 12% and then they get paid and they buy, more shares of that. And they're averaging down and they're pulling it down 0.5% or 2% or whatever. And they keep adding to the position. That's cool if it's a position that you want for a long, long time and you're accumulating. However, what I am specifically talking about is getting out of your trades with de-risking and a way to do it and to achieve it by not losing as much money. Remember when I said that the guy had 150 grand and he lost 30%, he only had 100 grand? Well, what I'm showing you is that 50,000 that the guy is down. What if you did this strategy and you sold every position that you had at 5% or less loss, and now that $50,000 loss is now $7,500 loss? That's what I'm trying to teach you, okay? A lot of people average down into something like whatever the stock is, that doesn't matter, or crypto. What I'm saying is you put it in heavy. You lower that cost down to 1%, 0.5%, whatever that number is, and you pull it out. But you have the mentality, the reason you're doing it is because you're going to pull it out. And you're just de-risking and you're protecting your money with your money.